What's your portfolio done and how have you adjusted it in order to take advantage of the way the framework and environment is changing? This week, we're speaking with the head of ETFs and alternatives from BMO Asset Management, and we're going to talk about the world in 2025 and what it looks like now and what it might look like in 2026, taking into account geopolitics, the most recent federal budget, and things that you need to think about as an investor making better wealth decisions.
This is Make Better Wealth Decisions, a podcast about financial blind spots, decision making, and how the reality of higher rates, global tensions, and tariff instability impact your investments. I'm your host, John DeGuy, a portfolio manager with Design Securities in Toronto.
This week, we're speaking with Bipan Rai. He is the managing director and head of ETF and alternatives strategy at BMO Global Asset Management. He's highly regarded as a macroeconomic thought leader, and he has insights and knowledge with regard to market structure as well. Bipan, how are you today?
I'm well, John. How are you doing?
I'm also well. Just a little bit of news for the people listening at home. Bipan is a proud father, and his son is 1 month old today. So how's sleep going, Bipan?
Sleep is non-existent right now, but that's okay. When the baby smiles, I tend to forget all about the lack of sleep.
Good. Well, that's the right attitude to have. So I wanted to speak with you because you have a podcast of your own and you put out a daily newsletter with BMO Global Asset Management with regard to what's going on geopolitically. And so I wanted to have a discussion about geopolitics. But originally, we were going to have this discussion about a month ago, but you were called away because of your wife going into labor. So at that point, we were going to talk about the budget. So I want to talk a little bit about the budget as well.
Sure thing. Absolutely.
Can we begin by maybe having you offer up your view of the world in terms of how the geopolitical landscape is shaping up at the end of 2025?
Yeah, I mean, where to begin? It's a completely different landscape than I suspect a lot of our listeners are accustomed to. Over the past several decades, really, have been unprecedented in terms of the way in which the developed world, the Western world more specifically, has been able to coalesce around free trade and to come together with a mutual understanding of shared values insofar as, the economy and markets work. And it really feels like, certainly we did get a bit of this over Trump's first term, but it feels like this year, the start of Trump's second term, it feels like this has been a sort of meaningful departure away from that old, the decades-long march towards free trade into something that's a little bit more, for lack of a better word, balkanized when it comes to free trade, or at least trading going forward. So there's a lot more barriers, not just in terms of trade flow, but also capital flow that are going to impact portfolios on a go-forward basis and certainly lead to the rise in premiums that we haven't really discussed for several decades now.
And then on top of that, we have the rise of autocracy in autocratic states and wars, which are largely proxy wars, being fought between competing powers that are taking advantage of this bifurcation and coming apart of the world order as we had come to know it since the peace dividend of the Berlin Wall coming down occurred. It seems things are sort of going back to the future. Does that have any impact for investors? Or are there any things at all that you can point to that should cause investors to think differently as a result of these wars and the world becoming, for lack of better terminology, a more dangerous place?
Certainly. I mean, we could go back to the answer to the first question I gave in terms of, remembering how well integrated, the global marketplace was, right? So if you're manufacturing a car in Canada or in the United States, I mean, there's a lot of that goes into that and a lot of imports that are sourced from overseas. And now, sometimes I should also mention that, those imports were coming from countries that were historically not geopolitically aligned with us in this new environment, I should say. And, if that's the case, then it's going to be difficult for a lot of domestic manufacturers to source those imports and maybe look to reallocate towards more friendlier countries. And that's at the margin. What that does is, look, that's not an optimal way to allocate capital. It's not an optimal way to really source trade. And, that friction results in higher prices. And those prices, in the beginning, they might be eaten up by producers, meaning compressed margins just to retain their competitive standing in the marketplace, but that can only last for so long before it does filter through towards end consumer prices. So, I mean, to answer your question, John, I think the most direct way of seeing this in terms of investable themes is via higher prices.
So that's just another way of saying inflation. And
Yeah,
if inflation is
exactly.
going to be rearing its head in the coming months, I think it's safe to say that a lot of people were expecting it to be higher by now already, and it has
Yep.
not been. And we learned in the aftermath of COVID that central bankers and policymakers and talking heads can get things wrong. There was a lot of discussion about how this was going to be what happened in 2020 and 2021 was going to be temporary and was going to go away. And then it ended up getting a bit out of control. And central banks had to take draconian action in 2022 because it sort of got away from them. I don't
Right.
think anybody's really thinking it's going to be quite that extreme going forward. But as we record this in late November, there's some discussion about how central banks, at least in Canada and the US, might cut again in December. And I wonder what your thoughts are about whether or not that's likely. And even if it does happen, what do you think it is likely to mean for 2026, given what you said a moment ago about the longer term systemic inflationary pressure?
Well, there's a lot to unpack there. If we're going to start off directly in terms of what we're expecting for central banks next month, it does feel like the market is more and more convinced that the Federal Reserve in the United States is going to ease by an additional 25 basis points in December. I'm less inclined to believe that's going to be the case here in Canada. And the reason for that is, don't forget that the Bank of Canada did start its easing cycle before the Fed did, and it went at a substantially more aggressive pace than the Federal Reserve has. And you could argue that the bank, by doing that, was actually the timing, in a weird, dark way worked out for them, because earlier this year when tariffs kicked off and certainly had an impact on our economy, well, it turns out the bank had already been easing aggressively, albeit for a different reason. And, that should cushion the real economy for now. The big unknown for the Bank of Canada, obviously next year, is the USMCA agreement. So as much as we're talking about trade and tariffs, and obviously there's been let's call it a fissure in the relationship between the U.S. and Canada. Mm-hmm. Don't forget that a lot of goods export that leave Canada and go to the United States are still effectively tariff-free because they qualify under the USMCA. Well, it turns out that next year, both the United States and Canada are going to have to renegotiate that trade deal. And, I do a lot of things in my current role. One of the things I don't do very well is predict what politicians are going to do. And so that's the big unknown for the Bank of Canada. But as of today, given the available information we have on the economy, I mean, it does make sense for the Bank of Canada to stay on hold. For the Federal Reserve, I mean, you could argue basically the same thing. I don't think the Federal Reserve should be cutting. But what I think they should do and what they'll actually do are two totally different things. And again, it does feel like they're really bent on easing rates in December and a few more times in 2026.
Okay. So let's talk about two things that have been dominant themes for pretty much all of 2025. And they seem to be working at cross purposes. One is the rise of gold and its portfolio role and perhaps the reasons behind it. And the other is the rise of AI and how markets are hitting new highs. What are your thoughts on each individually and the interplay of the two?
It's a good question. I mean, those have been two fairly prominent investment themes this year. I'll start off with gold, just because, you hear the same thing in the media all the time about gold's utility as a hedge against inflation and also as a diversification instrument within a portfolio. Both of those are true. And you've probably also already heard about the debasement trade and how that benefits something like gold, given the fact that it is denominated in US dollars. So, that should be a good reason to be long gold. I mean, I'm not going to push back against that narrative because I do think it's true. I just think it's played out a little bit. And there are other deeper reasons to understand gold's rally this year that go beyond that. So if we break it strictly to a supply-demand perspective, demand is coming from four sources. Jewelry and fabrication, that takes up 50% usually on an annual demand pickup. The second is usually retail and institutional investors. That accounts for 30% of demand. And then the balance really comes from central banks and maybe technological purposes, right? So this year, the demand has been primarily driven by retail and institutional investors. You can see that via ETF flows that have been tracking higher. In 2023 and 2024 is actually a different story. It was actually central banks buying more and more gold. And so you've got that sort of demand against supply that really doesn't grow by that much on an annual basis, maybe 1% to 2%. And that's from mining activity and also recycled jewelry. And, if that's the case, then, I mean, the guts were there for a meaningful rally this year, given the level of, the institutional retail FOMO with the price of gold and, of course, the hedge test, the guess, the hedge virtues of gold during inflationary periods. Do we think that's going to continue into 2026? Yes, albeit to a lesser extent. I mean, we're still optimistic on gold. We still think 4,500 is achievable by the midpoint of next year. And certainly, that does speak to gold's utility and the sustained increase in demand relative to supply that we expect into 2026. With respect to AI, now AI, there's a lot of things that we can unpack there. But I think the key thing to understand for your listeners is this. As of now, we still don't know fully how AI is going to contribute to long-term sustained profitability for a lot of the firms that are investing in it. Other than they might replace jobs and reduce headcount, which reduces expenses. And again, that's not really sustainable over the long term for an economy. But we know that there's a huge, massive race going on in terms of spending, and everybody's trying to compete against each other in this space. The problem now is that not a lot of them can fund it via endogenous cash flows. So they're relying more and more on external debt financing, both off balance sheet and on balance sheet. The problem then is that the more and more you rely on that, the more and more this AI quote unquote bubble becomes comparable to prior periods of crisis and bubble-like behavior. And I think that's what everyone is afraid of at this point. To me, as a macro expert, as a market participant, I look at that and I see this as a healthy thing because it tells me that there's going to be winners and losers in this AI race. And this isn't just a beta play anymore. This is going to be something that's going to be a little bit more alpha. And in that case, I think it's a good thing that markets are taking a more judicious eye as to who's going to win versus who's going to lose. But if we're talking about AI, this level of spending on a go-forward basis, I still think there's room for this story to run at least into the mid part of 2026. And again, there's still money to be made in the AI space. It's just going to look a little bit different than what we've been accustomed to.
Great. Okay, that was helpful. Thank you. Let's see if we can shift over to a budget that came down basically 4 weeks ago now. And it was long in new capital budgeting and a framework that was going to change things in terms of invest more and spend less was the bump that we got from the government. A lot of what we saw were investments that build Canada's economic strength for decades to come. At least that's what we were told. What are your thoughts about having government put policies in place that would accelerate infrastructure, capital spending, and what does that mean for investors? Should investors, for instance, try to participate in infrastructure expenditures perhaps more than they otherwise might?
Unequivocally, yes. And I think the answer to both of those questions from me, John, is yes. And the reason why is very simple. If we are seeing trade barriers go up between Canada and the United States, I should say, that means at the margin that we're going to bleed growth compared to what we had before under the free trade model. And, in that case, it makes absolute sense for the fiscal policy to be a bit more looser and for the government to spend more on particular projects that, one, have been in long need for upgrading, and two, can lead to long-term sustainable employment and certainly lead to national prosperity over the medium to long term as well. There's going to be a degree of friction between the industries that are impacted by tariffs and maybe some new industries that are created via the shovels in the ground approach. But certainly, we've seen this time and time again from prior periods where governments have invested in the economy during downturns. They do tend to lead to long-term growth, depending on what the actual multiplier does look like. But infrastructure tends to have a decent multiplier when the economy is going towards a rough patch. And we suspect that the projects that have been announced so far, or at least the ones that Prime Minister Carney has recommended to be fast-tracked through the Major Projects Office, this could be something that could benefit those localized areas. Of course, we would like to see something that is a little bit more interprovincial and really speaks to the fact that there is a meaningful shift in growth strategy. But look, this is a good start. And we're seeing spending on projects that have been in sore need for quite some time. And for investors, the meaningful takeaway here is this. When you look at an infrastructure fund, remember the exposure there is ultimately towards long duration revenues that ultimately depend on inelastic demand. And that's why, when we look at, say, if we're looking towards, alternative assets that can be an effective diversifier and also a hedge against inflation, and you want to go above or beyond gold because you're already maxed out in terms of your allocation there, infrastructure is not a bad place to be for that reason, right? It's the same types of virtues as gold, only that over the medium to long term, there's an economic need for it. And again, we do think that this is going to bear fruit over the medium to long term. mean, there are other things we could talk about within the budget that I think are important as well. I mean, certainly the tax incentives that were announced, also, the degree of encouragement, I should say, when it comes from the federal government towards private sector participation in some of these projects. I mean, that's going to benefit participants that we're probably not even thinking about, including banks as capital deployers. Yeah.
So it's funny because I did my graduate work in public administration, and what you just talked about, Bipan, are what are oftentimes referred to as framework policies, where you basically set the table and say, here it is, and come fill your plate if you want it. And if you don't, that's fine. But we're not going to pick winners. We're just going to put a framework in place that will allow those people who want to self-select into putting shovels in the ground to be able to do so.
Absolutely.
What about a couple other industries? Housing. I want to get your take on housing, and I want to get your take on clean energy. What are your thoughts on those two?
Look, when it comes to housing, I think there's a sore, obvious need for it in this country. And I'm not just talking across the country. I'm talking about a few key markets, including Toronto and Vancouver, most notably. I mean, we could talk about the run-up in prices, but ultimately that really does speak to the basic law of economics, meaning that the market is going to clear at a certain point where supply meets demand. And it's just been that if we talk about housing, particularly in the single-family detached area, there just isn't enough to satiate the level of demand, right? And we could see housing maybe go on the defensive a little bit in terms of how the market moves, and that's really a response to the fact that the government has taken a different approach when it comes to immigration and the like, and really been somewhat slower moving when it comes to housing on a go-forward basis. But nonetheless, I mean, the measures taken by the feds here is a step in the right direction to potentially help improve not just the supply of housing, but potentially also affordability of it as well. So again, will this bleed through and potentially help the real estate sector, that portion of the equity market? That remains to be seen. I mean, there's other factors that also play into effect there as well. I mean, it's not just a univariate relationship, but nonetheless, I mean, that would be the first place potentially that could stand to benefit as more and more developers get involved in the process of building our homes. Clean energy, I mean, there is a commitment to clean energy here in Canada that I think is going to be substantially important to pay attention to over the medium to long term. That's something that, John, I'm keeping an eye on for now. I don't really have an investment recommendation tied to it, but it's certainly front and center as part of this government's energy approach as well.
So one of the things I can't help but note, last year I read Mark Carney's book, Values,
Yep.
And it is rife with recommendations, actionable things that he has done at Brookfield and his work with the UN and so forth, that there's no real doubt in my mind that he is going to be committed to making Canada an energy superpower, both in conventional and in clean energy. I don't think that's in dispute. That the problem is there are a lot of people who are perhaps worried about the way the rhetoric isn't lining up, because he got rid of the consumer carbon tax immediately after being sworn in as prime minister, even before the election. And there are now some people that are wondering, well, is this guy really committed to this, or is he just another politician who's going to say whatever needs to be said? So my sense is that Mark Carney is definitely going to be committed to clean energy down the road. It might not take the shape and form that we originally anticipated, but there's no doubt in my mind that it will still be a major driver in public policy decisions going forward. Any thoughts on that?
No, I absolutely agree. There's a commitment to the construction of low carbon LNG facilities, and again, that came through as a big part of the tax incentives that were announced in the budget. Including allowing for immediate expensing of machinery and equipment that is used in the manufacturing, processing, and clean energy investments. And I think that is the approach that he's going to take, as opposed to just penalizing us via the demand side. I mean, Carney is very much focused, I think, on building out the supply side first.
So given all these things, given that we are in a more uncertain world, a more unstable world with more frictions and supply chain challenges and risks and volatility, what should investors be thinking about when they go about making hopefully better wealth decisions?
Yep.
And I'm not talking about a wholesale, throw the baby out with the bathwater, but on the margin, if there are things that they can think about that might be able to take advantage of the landscape as it's now evolving, what are the sorts of maybe 2 or 3 things that you might want to have people look toward?
Yeah, and I think it's important to remain invested. And again, a lot of your listeners will know this, but it serves to be reinforced. I mean, just think about the environment that we came into this year, right? I mean, everyone was fairly constructive given the fact that we had Trump coming into the White House. So that meant tax cuts and deregulation. Here we go. But what ended up being his priority was actually the tariffs. And what's more, the object, or at least the country that was front and center in the tariff storm was actually Canada. Two outcomes that we wouldn't have predicted. Then after that, we got Liberation Day, and then after that, we got sectoral tariffs. Then after that, we came close to a war in the Middle East. Think about all of these different things that have happened. And of course, we've got the AI bubble to contend with now. And if you gave me that list of observations, last November the 26th of 2024, I would have told you. I mean, the S&P 500 is probably down, right? But no, it's actually up. So again, and this is after we had that meaningful drawdown in April post-Liberation Day. So again, remaining invested, understanding that this is a long-term game and not just, a short-term trading environment. I think, that's something that should serve to, or at least be a reinforcement sort of theme that everyone really internalizes on a go-forward basis. The second theme that I want people to remember and to take away here is, we touched on inflation earlier, but we are heading into this environment where inflation, or at least the floor for it, is going to be higher for longer, right? And if that's the case, then your benchmark, or at least your hurdle rate for returns, also should move up in a commensurate manner as well. And that's going to require, again, out of the box thinking, and also understanding that there's a list of investable products out there that can help you achieve those goals, as opposed to just blindly going along the S&P 500. I think if you do that, you're really putting on blinders and really neglecting the fact that you're not going to get those 2023, 2024 type returns. Again, you're going to need to be a little bit more diversified and to look outside of your usual comfort zone to get those gains. But of course, do your due diligence, understand the risks, understand the product, and map out a plan with your advisor to achieve those returns.
Perfect. Music to my ears. It's a lot of those things that you're saying right now, Bipan, are things that I've been saying for literally years. So it's nice to hear that there's some simpatico, when people come on and they say what I've been saying all along. So we're at the end. I have my last question is always the same for all my guests, and that is, the podcast is called Make Better Wealth Decisions. If it was up to you and you can impart one piece of wisdom to listeners today to help them to make better wealth decisions, what would that be?
Look more and more at alternatives as a diversifier going forward, right? So if we're talking about higher inflation, we're probably going to come into a sort of macroeconomic situation where stocks and bonds become more and more correlated. Bonds aren't going to be as good of a diversifier. You can get that by looking at in the alt space. I mean, gold was it this year. Infrastructure could be it next year. I mean, this is part of my answer to the prior question in terms of thinking outside of the box for that diversification instrument.
Perfect. Okay. Bipan, I want to thank you for your time today. It's been a real pleasure, and all the best, and get some sleep.
Thank you, John. It's been a treat.
This podcast is not to be construed as offering specific investment advice. Please consult a qualified advisor before acting. My books, Stand Up to the Financial Services Industry and Bullshift, are available online. If you'd like to meet to discuss how the topics in this podcast affect you directly, please visit my website.